This is the Simplify Aggregate Bond ETF, ticker symbol AGGH. In this video, we'll discuss what is AGGH, how AGGH is managed, and portfolio use cases. AGGH is a core bond fund. It's designed to have similar characteristics as the Bloomberg Aggregate Bond Index. It's actively managed to seek enhanced income and total return. The active management is comprised of 3 steps. Step 1, buy bonds with the highest risk-adjusted yield. Step 2, use Treasury futures to set the target duration. And Step 3, seek to enhance income by selling options. Let's take a closer look at each of these 3 steps. Step 1 is to buy bonds with the highest risk-adjusted yields. The goal here is to maximize yields without increasing credit risk. In other words, AGGH will not seek to increase yields by dropping down in credit quality. Examples of sectors that might get emphasized are Treasury inflation-protected securities, or TIPS, and mortgage-backed securities. The idea is to overweight these types of sectors when yields are trading above their historical averages versus Treasuries. Step 2 is to use Treasury futures to set the fund's target duration. As part of this step, AGGH selects futures from the more favorable points of the Treasury yield curve. Here's an example of why AGGH does this. The portfolio is tilted towards mortgage-backed securities when they have high historical yield spreads versus Treasuries. But this shortens the overall portfolio duration, as mortgage-backed securities typically have shorter durations than comparable Treasuries. A small allocation to Treasury futures can bring the overall portfolio duration back to levels comparable to the benchmark index. The next part of Step 2 is selecting futures from the most favorable points on the Treasury yield curve. Here's an example. In 2023, there was a spike in the 20-year part of the Treasury yield curve. The slope of the yield curve was also steep near the 20-year mark, adding attractive carry. Because of a combination of the higher yield and steeply sloping curve, futures on the 20-year Treasury made an ideal vehicle to manage the portfolio's duration. Lastly, AGGH seeks to enhance income by selling options. This is done to harvest structurally attractive fixed-income option premiums. Here's why there's structural opportunity in selling interest rate options. Dealers, especially those involved with mortgage-backed securities, have a continuous need to hedge their interest rate risk. They do this by buying options. This high structural demand to buy options increases option premiums and adds to the profitability of option selling strategies. Here's how it works. The option type will be puts, calls, or sometimes both puts and calls, depending on market conditions. Strike prices will typically be set with a 90 to 95% win probability. That is, a 90 to 95% probability that the options will expire out of the money. For those familiar with options, this translates to option deltas between 5 and 10. Option tenor, or time to expiration, will typically be about 1 to 2 months. Lastly, risk management includes laddering options to manage timing risk, as well as tactical exit and entry points, especially when volatility is elevated. AGGH has 2 portfolio use cases. It is a core fixed income holding for investors seeking to enhance total return, income, or both. It can serve as part of a fixed income allocation, or, due to its nature as a core holding, can serve as a single ticker fixed income solution. Now for some Q&A. What are the risks of investing in AGGH? On an absolute basis, AGGH is a bond fund. Therefore, like all bond funds, the primary risk to the fund will be rising interest rates. On a relative basis versus other core bond funds, the primary risk is bond prices moving adversely to the options positioning. So if the fund has sold puts, that would mean falling bond prices, or if the fund has sold calls, that would mean rising bond prices. Why does AGGH own some ETFs rather than just buying the individual bonds directly? Buying ETFs can sometimes lower transaction costs. In addition, many ETFs have the ability to write options against them, which is a core part of the fund strategy. Are shareholders paying the expense ratios of the underlying ETFs in addition to AGGH's expense ratio? No. AGGH's published expense ratio is inclusive of all the expenses of the underlying funds. What is the fund's tax treatment? Coupon payments and option premiums are treated as ordinary income. Gains on Treasury futures contracts are treated as 60% long-term capital gain and 40% short-term capital gain. The fund seeks to pay monthly distributions. Thank you for watching this presentation. For more information about AGGH or any other Simplify ETF, please go to simplify.us. We'd like to hear from you directly, so if you click the Contact Us link at the top of the page, you can leave us a message and we'll respond promptly.